Welcome to Financial Accounting. This is from a merchandiser's perspective. We're going to do some transactions today related from the buyer's perspective. So we're going to buy a couple of different things from a couple of different wholesalers in some different scenarios. Here are the transactions, and we're going to handle these one at a time. Our company name is going to be 26.2. In our first transaction, we purchased inventory on January 2nd for $12,000. We did this on credit, and our terms were 210, which means we get a 2% discount if we pay within 10 days. So we have to pay this invoice by January 12th to get the discount. And N45 means the whole bill is due in 45 days. That stands for net 45. FOB shipping point tells us where the title transfers. So shipping point, FOB shipping point means the title transfers at the carrier's loading dock. So if UPS is our shipper, when we deliver the goods to the shipping point, if we're the seller, they're no longer ours. So title transfers over to the buyer while it's in transit. So that means the buyer pays the shipping if it's FOB shipping point, and we are the buyer in this example. So in this transaction, we're going to first debit merchandise inventory for $12,000. We're going to credit accounts payable for $12,000. Next, we're going to pay the freight. So we are not going to debit freight expense here because this is a inventoriable cost to us. And the way to remember that is freight in is inventoriable. So think of the word in. Freight in, inventoriable cost. That means we need to add it to our merchandise inventory account. So we're going to debit merchandise inventory for $900, and we're going to credit cash since it said we paid it today. Now on the 10th, for whatever reason, we didn't like the goods that Roadrunner shipped us, so we're going to send $1,200 worth of them back. So we're going to reduce our liability account by $1,200, and we're also going to reduce our inventory account by the $1,200 worth of merchandise that we shipped back to them. We no longer have that. Now we paid our bill on the 18th, which is past the 10 days. Remember, we would have had to have paid by the 12th because we originally purchased on the 2nd. We are not within the 10-day prompt payment window, so we're only going to pay our bill for less the return. The $1,200 return will be subtracted from the $12,000 purchase, so we're going to reduce accounts payable by $10,800, and we're going to credit cash for $10,800. Next, we're going to purchase more inventory for $8,000 from a footwear company. And the terms here are 310 net EOM, which means we get a 3% discount if we pay within 10 days. The net amount of the invoice is due at the end of the month. And this term is FOB shipping, FOB destination. So that means the title transfers when it gets to the buyer's door. Okay, so when the goods were in transit, they still belonged to the seller because the title doesn't transfer until it gets to the destination. So we are the buyer, so we are not going to be responsible for freight at all in this example. We're going to debit merchandise inventory for $8,000 to increase our asset account, and we're going to also increase the liability by $8,000. On the 21st, we received a $500 allowance from Outdoor Footwear for damaged but usable goods. So this means they're not wanting the goods back. We can still use them, but let's say the shoes got to us and they were really dirty. So we're going to have to clean them up, but we're still going to be able to sell them for full price. So we call the company up and say, hey, this is what happened. This isn't acceptable. And they say, you know what, go ahead and keep the shoes. We'll just credit your account for $500. So what they've done is we're going to reduce the liability, the amount that we owe them, by $500, and we still have to report inventory at cost. So since we were given a $500 allowance, that means we don't have to pay that $500, and the inventory didn't cost us that $500 in the end. So we're going to reduce merchandise inventory by $500, even though we're not sending it back. What we're doing is updating cost here. Okay, now this is the 24th, so we have actually paid within our prompt payment window. We originally purchased these items on the 20th. Today is the 24th, so we're well within our 10 days. So we're going to get a 3% discount. So what we're going to do, we have to get rid of the accounts payable for whatever is in it. So we originally put $8,000 in there, and then we took out $500 for the allowance. So we get rid of the liability for $7,500 because that's what's in there. But we're not going to pay them the full amount because we get a 3% discount. So the easiest thing to do here, take your 7,500 and multiply it by 97%. That's going to tell you that you didn't pay 3%, but you paid 97%. So that's going to give you your 7,275. Then we're going to credit merchandise inventory for 3% of 7,500, which reflects the 3% discount that we were given there. Again, updating the merchandise inventory to cost, which is now 3% less than what we originally thought. And that's the end of perpetual purchases using the new revenue recognition standard. I hope you enjoyed it.